Oh man. It's really funny to see in real time how the media paints a picture for people all over the world. I say funny, but really, it's infuriating too. So let's dive into how holiday spendings being up are supposed to be a good sign. So this article from NPR is titled Holiday Spendings is Up, Another Good Sign for the Economy. Data shows consumer spending from November 1st through Christmas Eve rose 3.1% year over year, a figure in line with the decade leading up to the pandemic and another positive sign for the economy. A positive sign for the economy, huh? People spending automatically means the economy is on the up and up. Got it. Let's check out another article. This one is from the New York Times. Holiday spending increased, defying fears of a decline. While the pace of growth slowed, spending stayed strong because of robust job growth and strong wage gains. Despite lingering inflation, Americans increased their spending this holiday season, early data shows. That comes as a big relief for retailers that had spent so much of the year fearing the economy would soon weaken and consumer spending would fail. The holiday sales figures, driven by a healthy labor market and wage gains, suggest that the economy remains strong. All right, so I love this next part, and you'll find out why in just a second. What we are seeing during this holiday season is very consistent with how we are thinking about the economy, which is that it's an economy that is still very much expanding. And of course, this was said by Michelle Meyer, who's MasterCard's chief economist. We are now entering the period, and we are seeing it to some extent during the holiday season, where consumers have built up real purchasing power, Ms. Meyer said. All right, so this all sounds great on the surface, right? Consumers are spending. They've built up their purchasing power. But it seems like these media outlets are ignoring where the money is coming from. Does anyone remember the August report when credit card debt hit $1 trillion for the first time? We can see on this article from CNN, Americans' credit card debt hits a $1 trillion record. Note that this was dated August 8th of 2023. So let's check in 3 months later to see where the credit card debt was at. So this article from CNBC states the following. Credit card balances spiked in the third quarter to $1.08 trillion, which is a record. Note that this was dated November 7th of 2023. So we went up $0.08 trillion in 3 months. Now, this might not sound like much, but that's $80 billion. And that's an 8% increase on an already record high. So this really isn't small potatoes. And I want to interrupt this fake news alert broadcast to give you a reminder to subscribe. Tim and I want to help people level up big time, so hit that daggone subscribe button. Okay, interruption over. Let's go back and check on that credit card debt on the 2nd of January when the holiday season ended. You can see at the bottom of this screenshot, I have the credit card debt encircled in yellow. Credit card debt after the holidays is at just under $1.3 trillion, and the average debt per holder is over $8,000. Ah, wait a minute. Was that part conveniently left out? So in 3 months, from August to November, we grew a record $1 trillion debt by 8%, or $80 billion. Then in just 2 months, in prime holiday spending time, we increased another 20%. That's an additional $200 billion in spending on credit cards in that prime time holiday spending period. $200 billion. We didn't do just a little bit of spending on credit cards. We did a massive amount of spending on credit cards. You talk about a false sense of economic health. High levels of consumer spending supported by credit card debt can obviously give very misleading pictures of the economy's health. It can also mask underlying issues like stagnant wage growth or income inequality, but we're not going to touch on that right now. Let's not forget also that all this credit card debt has been accumulated with higher interest rates. I mean, in the last 5 months, we added about $300 billion to a credit card debt that had just hit a record high of $1 trillion. We had 30% to a record high number in 5 months, and we did it with high interest rates. Yay! Fantastic. Great news, right? So we are looking at a major increase in household debt, likely going to have a negative impact on overall credit scores, which of course equates to more difficult and more expensive borrowing. So yeah, Yeah, in the short term, increased spending, even on credit cards, can stimulate economic growth. However, obviously, over-reliance on credit card debt can lead to economic instability. And in a downturn, consumers with high debt levels may drastically cut back on spending or default on their debts, which means economic slowdowns. And of course, if a significant number of consumers are unable to repay their credit card debt, financial institutions will likely face increased risk of loan defaults. This can impact their financial stability and willingness to lend. What is coming is not pretty. It's one of the reasons I am a big proponent of a precious metals IRA right now. Check the link below to protect your ass. Not only are precious metals an insurance policy, but they can also make you a lot of money on top of that. Most people have no idea that gold is up almost 3.5% over the S&P 500 this century, and it's up almost 4.5% on bonds this century. And that's with the precious metals market being quiet the last 10 years and the stock market doing well overall. I think what happens next is going to really shock a lot of people. Hopefully you are someone who is protected. I really don't see why people aren't rolling portions of their 401k over to a precious metals IRA right now. I just don't get it. But anyways, make sure you subscribe. Tim and I want to keep you up to date on the economy, good or bad. We will get you the truth. Talk soon.